Hello, my friends. Today is September 14th, and this is Markets Weekly. So this past week was a pretty good week in markets. We saw the S&P 500 basically leap higher. Now, not too long ago, things were looking pretty dicey, but it looks like the S&P 500 found support at the 100-day moving average and went straight up. Now, are we going to go on to new all-time highs, or are we going to triple top? I don't know. We'll find out soon, but I continue to be very cautious until after the November election. Now, today I want to talk about three things. First, what jumped out to me last week was gold. Now, we saw gold basically mooning and making new all-time highs. Let's talk about what could be behind that surge. Secondly, now, Mario Draghi released a newly authored report on European competitiveness last week, and it's been in the news a lot. Let's talk about what Mario is recommending and also why basically nothing will change. Okay, the last thing that I want to talk about is commodity prices other than gold. Now, while gold has been doing very well, if you look at the commodity complex, prices of oil, base metals have basically been imploding for months. Let's talk about what could be behind that. All right, starting with gold. Now look at this chart of gold prices. It looks like it's going to the moon, and it looks like it's going higher at an accelerating rate. Now remember, when we talk about gold, everyone looks at gold through a different lens. Now some people think of gold as an inflation hedge, and they will point to the hotter than expected CPI as a catalyst for higher gold prices. But I will also note that when CPI was printing at 8% year over year, gold was not doing very well. Another common lens to look at gold is through the lens of monetary policy. Now, we are in the midst of a global rate cutting cycle that could accelerate significantly. Now, we had the ECB cut rates again the past week. Bank of Canada has cut rates 3 times. And most importantly, the Fed is going to cut rates this coming week. 25 basis points or 50, so far it looks like a coin toss. Now the market is actually pricing in a pretty aggressive path of rate cuts though. Now going forward, other central banks like the Swiss National Bank and so forth are also going to be cutting rates. So basically all the central banks in the world are in rate cutting mode, maybe by a lot, and so gold looks to be responding to that and going higher. Now, another common lens to look at gold is through the lens of geopolitics. Now, what we've noticed the past few months is that when there's geopolitical conflict, for example, tensions in the Middle East, gold gets a pretty good bid. Now, this past week, there has also been pretty notable escalations on the Russia-Ukraine front. Now, there are reports from Politico suggesting that the White House is authorizing Ukraine to use Western-provided long-range missiles to strike deep into Russia. Now, in response to this, immediately President Putin came out and said that if Western missiles strike deep into Russia, we are going to think of Russia as being at war with NATO. Now, that is obviously pretty notable escalation, but it just marks the latest in a series of escalations we've seen over the past 2 years. Now remember, earlier in the conflict, the White House was saying that we would never send tanks to Ukraine. Then they sent tanks to Ukraine. Then we would never send fighter jets to Ukraine, and then they sent fighter jets to Ukraine. Then we'll never send missiles to Ukraine, then they sent missiles to Ukraine. But they could only strike certain parts of Russia, and now it seems like even that last red line is being crossed. So there's been a steady stream of escalations on the Ukraine front, so it's no surprise that gold is sniffing this out. Now, we don't hear about this a lot in the news, but it does seem like geopolitical tensions are boiling over. So that's, of course, another impetus for gold to rise. And of course, you also have these CTA advisors who basically trade on the basis of momentum, buying things that go up and selling things that go down. And with gold consistently rising, you're going to have a lot of people who just rush in to buy momentum. And so I think a lot of factors explain the gold's rise, and they look like they're going to continue. So I guess we'll see if gold continues to surge in the coming weeks. Now, the second thing that I want to talk about is the recently released Draghi report. Now, Mario Draghi, former president of the ECB, has been busy and released a report the past week on European competitiveness. Now, I think it's helpful to have some little bit of context to see why he's concerned about this. So here's a chart of GDP per capita on a purchasing parity basis, so adjusted for currency, of the US and the EU. Now, the US has always been on a per capita basis, okay, not always, for the past few decades, a wealthier country than the EU. But the gap between the US and the EU has steadily widened over the past few decades. So the living standards in the US have been increasing at a faster rate than that of the EU. Now, Mario Draghi is looking at this and thinks that this is due to the difference in productivity between the US and the EU. Now, what is productivity? Productivity is basically being able to produce more output with the same inputs. For example, if you were producing 10 widgets after 8 hours of work, and then after being more productive, you can produce 20 widgets with 8 hours of work, then you are being more productive. That means more goods and services are produced by you and your country. And so on a material basis, your living standards rise. Now, Mario thinks that the difference between US and EU productivity is largely due to technology. The US, we had this big tech boom in the 1990s, and the US was able to take advantage of newer technologies and improve their productivity. And it seems like we are at the cusp of another technology revolution with AI, and maybe the US pulls further ahead. Now, why is the US better at technology than Europe? Now, to be clear, Europe is actually a leader in many technologies as well. But when you look at their technological leadership, they seem to be focusing more on green technology, stuff like renewables and carbon stuff like that. Whereas I guess what people conventionally think of as high technology, let's say AI, cloud computing, semiconductors, Internet of Things, things like that, the US tends to be more advanced. Now, when you look at something like cloud computing on a market cap basis, the difference is actually pretty stark, where basically all the leading cloud computing companies are in the US. So another reason why that the US could be leading is not just its emphasis on these technologies, which tend to be more productivity enhancing, but also there's a lot more funding involved. So the EU does have really good technology companies, but oftentimes they move to the US where they can get more funding and support. Now, in the US, venture capital is a much more prominent part of the capital markets. So if you are a startup, it's easier to get funding from the US, where of course failure for startups is also not as much penalized. So the US seems to have a lot of structural advantages when it comes to technology. And I would also note that I think on a cultural aspect, the US seems to be much more open to new technologies. Amazon, for example, a child of the 1990s tech boom, is everywhere in the US. And very commonly in the US, if you want something, you order it on Amazon, where you can get a low price and you can have it delivered to your house, sometimes within hours. Whereas in Europe, technologies like Amazon are not adopted as much. Now, Amazon is in Europe and competitors are there, but a lot of times there's a lot more resistance where local people would say, make a point to not order from Amazon, but buy locally in an effort to support local industries. So there's that culture aspect there. But in the US, of course, people don't do that, and so brick and mortar companies basically go bankrupt. However, those brick and mortar companies then buildings get repurposed for other things, their employees find new jobs, and also new businesses are born where there's a lot of people who go and can sell directly on Amazon, be it drop shippers or people who have their own business. So basically, the structure of the economy in the US is a lot more dynamic, which at the end of the day results in lower prices for consumers, opportunities for up-and-coming businesses, at the expense of incumbent businesses. And yes, that is sad, but you can see on the aggregate, people tend to benefit when you can have change. Now, another thing Mario points out is that energy prices in the EU are a lot higher than the US. As we all know, Europe is highly dependent upon imported gas from Russia. Now, European leadership tends to focus a lot more on clean energy solutions, and by that they mean solar and wind rather than, say, nuclear, which in some countries seems to be in the process of being decommissioned. Now, green energy, low carbon, great, but also a lot more expensive when compared to something like natural gas. So when you look at energy prices between the US and the EU, energy is a lot cheaper in the US, and that's a huge advantage when it comes to things like manufacturing or even very high-tech stuff like data centers. Now, Mario's solution to this gap between, say, technology and higher energy costs is more investment. He wants the EU to spend 800 billion euros a year to support European growth, which of course is a great idea, except as we all know, that will never happen. Now, in the US, when the government wants to spend more money, they just basically have a magic money tree, print more treasuries, and for whatever reason, the market is very hungry for US treasuries, no matter how much they print. In the EU, there is no joint debt market, so you don't really have European-wide treasuries. And when you try to have EU-wide debt, you have countries like Germany very clearly oppose it. They don't want to be liable for, say, the spending of Portugal or Italy and so forth. So if the EU were to raise more money to try to have more investments in technology, they were going to have to raise taxes, have, say, a EU-wide income tax or something like that. Now, that is also very difficult to implement. The EU, composed of many members, a lot of political consensus needs to be built, so it's very difficult. So at the end of this day, this proposal, which articulates the problems of Europe very clearly that everyone agrees of, proposes sensible solutions that can never be implemented. And so it seems like this productivity gap, this living standard gap that we see between the Europe and the US and actually many other countries as well is probably going to continue for the foreseeable future until it cannot, and then maybe we'll have big change. Okay, the last thing I want to talk about is the commodity markets. Now, we talked about gold mooning, but other commodities haven't been doing as well. When you look at commodities like oil, like base metals, honestly, it looks like they're imploding. Now, if you're looking at commodities as a signal for, say, global recession, well, then you have to be paying attention. Low commodity prices usually suggest weak global demand, which in turn suggests global recession. But we also have to have a little bit more nuance. Lower prices could be due to weaker demand, but it could also be due to increase in supply. Looking at oil, I think according to the recent IEA oil report, it looks like oil decline in prices largely due to China. Growth in oil in China has been very disappointing, and that's resulting in weaker oil prices. And in addition, there seems to be many offshore oil projects that are coming online next year that seem to promise increases in supply. So you have both demand and supply things impacting oil right now. But the weakness in Chinese demand is real, and that seems to be spilling into other commodities like iron ore and copper. Now, China is the largest consumer of iron ore. As we all know, China is the workshop of the world. They import raw materials, manufacture cool stuff, and then sell it to the rest of the world. Now, the Chinese economy, as we've been discussing the past few months, has not been doing well, in large part because of the deflating of a ginormous property bubble. A lot of GDP growth in China over the past few, actually decades, has been investments in real estate. Basically, China has been building more and more new buildings, bridges, infrastructure, and so forth, and that's been driving a lot of growth. But now those real estate investments haven't been doing as well. Real estate prices have been declining, and so property developers are not building as much new construction, and households who own real estate are seeing their net worth shrink and are less inclined to spend. So that all suggests weaker economy, less demand for commodities. Now, I think it's also important to note, though, that China, globally speaking, is more of a source of supply than a source of demand. And so when the Chinese economy is not doing well, yes, they will import fewer goods and services from, say, the US. But to begin with, though, they weren't a very big part of demand for American companies. The flip side is more true, where American consumers are a big source of demand for Chinese goods and services. And so as the Chinese economy slows down, that suggests lower import prices for the US, which you kind of see, and lower commodity prices, which of course also is an import price as well. So in a sense, it's having disinflationary pressures on US inflation. On a market-based signal, you can also look at the Chinese government bonds, where the 10-year Chinese government bonds, the yields are declining pretty notably. So it does seem like things are not going well over there. Now, President Xi has been quite adamant that he doesn't want to do a lot of fiscal stimulus. He thinks that's not good. He doesn't want to just, print money and make things go away like the West does. But it's also possible he could change his mind if things become more dire. Now, looking at US CPI, we can see that headline CPI has been pretty subdued because that includes things like commodity prices, whereas core CPI has been more elevated. So going forward, this likely suggests, because of lower commodity prices, that headline CPI is going to be pretty benign for the coming months. All right, so that's all prepared. This week is an FOMC week, so I'll be back to give you my FOMC debrief. Now, today we're in a pretty interesting place because the market is pricing in a 50% chance of a 25 basis point cut and a 50% chance of a 50 basis point cut. As we all know, the Fed does not like to surprise the markets, so this is a pretty unusual situation. My best guess is that the FOMC actually does not know what kind of consensus it can build, and so it's preparing the market for either 25 or 50. So we'll find out soon what actually happens. Now, remember to like and subscribe. And if you're interested in hearing my latest thoughts, check out my blog at fedguide.com. This week, I will make the case as to why aggressive rate cuts are actually bearish equities. And if you're interested in learning more about markets, check out my online courses at centralbanking101.com. Talk to you all soon.